Okay, we're going to get started today by looking at the front page of Yahoo Finance. You can see that oil is half of the front page stories here. We have Trump says U.S. to help some ships leave Hormuz. We have some de-escalation of the war in Iran. So if we have a war that we have some kind of truce or end of the war, that will make the stock market go up 5-10% that day. It's like a binary situation. We don't know how long it's going to last, but the right now the price of oil is unchanged. This news story about U.S. and Iran inch toward peace talks, you can't count on that as an investing thesis. You have to invest in quality stocks and kind of ignore the geopolitical stuff. Okay, so let's look at the S&P 500. Hold on for a second. Okay. All right, you can see that we're basically in an uptrend here. We're almost every chart that we're following, we're pretty much at the top of our channel and we're overbought. And we're in basically rally mode right now with a lot of the sectors and stocks we're following. We've had some good earnings reports this past week. That's basically given the AI infrastructure and AI stocks a good reason to keep going up. Right, okay, you can see that we're above all the moving averages and and let me see. Okay, and let's look at some of the stocks that reported their earnings this past week. You can see that we had a huge Wednesday of earnings reports. We had Alphabet, Meta, Amazon, and Microsoft come out with earnings. I think the star of this week was Alphabet. They had the best earnings report. They went up 10% on the earnings report. So that was really good. They're the only stock in the AI mega caps that is actually showing that they make profits from their AI. Everyone else is investing in AI, but not really showing a return on investment yet. So that's why Alphabet was rewarded this week. Visa reported they came out with earnings that were better than expected, and they went up 10%. And Eli Lilly, very similarly, they came out with earnings that were much better than expected, and they went up lots. Altria, they went up 10% on their earnings. Um, we also had Apple do really well. They went up 3 to 5%, and SanDisk also went up 8%. And so we had really good earnings reports this week. So that's going to give the stock market in general some momentum going forward. All right, so let's look at the earnings reports that are coming out next week. We have AMD. This is probably one of the biggest, most important ones. They make semiconductors, a competitor of NVIDIA and Intel right now. We have Walt Disney coming out with earnings on Wednesday. We have Uber coming out on Wednesday, and we have McDonald's. Those are some of the biggest stocks. Um, and I think a lot of the big tech stocks have reported. We have and NVIDIA and a couple others they're going to report later on. All right, so let's look at, okay, some of our statistics. We have 56% of S&P stocks above the 200-day moving average. Our formula is if the S&P stocks, if 70% or more are above their moving at the 200-day moving average, that is a sign that we have super broad market strength. Right now we have, um, I like to say, we almost have like a breadth thrust right now. I didn't see anyone write about it yet, but this is going up a lot in a short amount of time. That gives the stock market a lot of momentum. Um, we'll look for some more statistics on that later on. Let me see what else we got to say here. Okay, so May is traditionally a very good month. Actually, April was one of the best Aprils in recent memory in 50 years. And so this seasonality actually worked this month. And May is actually supposed to be a good month too. So May is up usually 1% on average and has low volatility too. Look at this VIX during the summer months, usually very low volatility. Um, but keep in mind that June and August, September are traditionally months that aren't that great in the stock market. So you got to be ready for that. You got to be ready for there to be less trading, less interest in the stock market as people are on vacations. And um, that's something to keep in mind. Okay, so let's look at the S&P 500 in general. We have the S&P along with a lot of the other stocks we're following are at the top of their trading range. And we've been overbought for a good month now. And let me see. The S&P short range oscillator is 2.48. That is overbought. So the S&P short range oscillator, that any value above 5 suggests the market is overextended to the upside and due for a pullback. So we're not over 5 yet, but we are overextended. So the time now, whenever it was negative, that was the time to start looking to buy. So that was like down here and down here when we have oversold conditions. Okay, so now let's look at the 10-year Treasury. This is very interesting. We've had an inverse correlation for the 10-year Treasury yield and the S&P. This is the S&P 500. This is the 10-year yield. You can see that this week we had a one-to-one correlation as the yield to the 10-year went up, so did the stock market. So let's see if that continues. All right, so let's look at some of the variables in the stock market. Last week, the price of oil was $94 a barrel. Now it's $101. That's up almost 9.3%. That is a lot to go up. A lot of it has to do with the war in Iraq, the closing of the Strait of Hormuz, um, and possibility of it being resolved. Um, Inflation is basically hasn't changed since last week. It's 3.30%. Um, the reason why we keep track of inflation is if you have money saved, let's say you have $1 million and you put it in a coffee can and put it in your backyard and you dug it up in 10 years, you're going to lose 3.3% buying power every year. And so whenever you dig it up in 10 years out of the backyard, you're going to be able to buy maybe $800,000 worth of merchandise with your $1 million because of inflation. So that's why it's important to keep in mind the inflation when you're investing. You want to invest in a way that you're beating the 3.3% inflation rate. Okay, so the US dollar index is unchanged. Okay, that's 2 weeks in a row it's unchanged. The price of gold went down 2.5%. This is not acting like it normally does in right now it's we're in a geopolitical event right now with the major things going on um, that are bad for the price of oil, et cetera. And gold hasn't been going up and hasn't maintained a certain stability. So that's interesting. Um, let's look at the US dollar index. It's been steady. It's been pretty consistent within this range. That's pretty good for corporations because corporations have to, when they give their earnings reports, a lot of multinational companies might be affected by the dollar, and having a steady dollar is pretty good for corporate earnings. All right, so look at the C and then fear and greed index. We see greed. It's a little bit more greedy than last week. So as the stock market is recovering, I guess I guess when we look at the S&P, as the stock market goes up, people start getting greedy and less fearful because um, there's just a pattern where people see stocks going up and they get greedy. So that's what's happening right now. If and look at the amateur investors, they're becoming bearish, believe it or not. Majority of investors, it's almost the same as the bullish. So we don't have a true confirmation of this greed in the amateur index. We have they're bearish this week. Time to start looking for things to buy or don't sell. That's the translation. Okay, so right now the VIX is really low. It's kind of at 17. That is relatively low. Look at this range right here. This is the lows you can get. So we don't have people afraid of the stock market going down now to buy protection. Right now we have greed in our emotional graph. Um, Whenever people are greedy, usually we try not to buy or we try to sell or don't buy whenever people are greedy. Um, Whenever people are capitulating and there's despair, then we look for things to buy. Okay, so okay. So let's look at some of our best and worst performing sectors in the stock market. Mm, Energy is the best performing sector this year. You can see IT is at 10%. That's not bad, along with consumer staples and real estate. Actually, these were the worst last year, and they're in the top five performance-wise this year. So consumer staples and real estate, hmm. Consumer staples, they pay a dividend. They're consistent in good times and bad. Energy has gone up with the war, basically. Let me see. All right, and this is very interesting. Financials, they are one of the worst performing sectors this year, and they're the least. Look at this right here. The financials are the most undervalued relative to history of all the sectors. So they're 41 percentile compared to maybe industrials, which are the most valued, the highest valued companies. Why would wait, why would industrials command such a high premium? Perhaps because we have an infrastructure bill in America that was passed, and we also have AI data centers, which is a lot of their why they're up so much now. Okay, that was good little exercise. So we have the energy sector, materials, industrials, real estate, consumer staples, and communication sector. These are the best performing. Let's look at some of the sectors that are going up and down today. Okay, so we know, okay, so right now let's look at the 10-year. Okay, we see that the 10-year yield is going up. So because it's going up, we have to have a translation. It often signals expectations of stronger economic growth and higher inflation. A rising 10-year treasury acts as a headwind for the stock market, increases the cost of capital, and offers higher risk-free return. Okay, so we're going to have, with a higher yield, we have anything yielding, it's negative for high yielding stocks because you have competition with the 10-year yield. You have, it's negative for small cap stocks, tech and high growth stocks. It's positive for financial, banks, industrials, and value stocks. Let's see if that worked out in our top sectors. Okay, we have the stocks performing the best and the worst. Let's look. Okay, we expected, okay, telecom, as the yields of the 10-year go up, you would expect the demand for high yielding investments like the telecom to go down. So that's opposite what we expected here. As the 10-year yield goes up, the companies that are growth stocks, such as the semiconductors, they go down. So we have it didn't work out that way. We have different reasons for these sectors to go down and up today. Um, as the yield for the 10-year goes up, housing definitely will go down how because there's a less demand for houses whenever interest rates go up. Biotech, that makes sense because as the yields for the 10-year go up, companies that are heavily indebted, like biotechs, they have to pay more to borrow money. And home builders, that's the same as the home construction. That's the same reason. Healthcare, they pay dividends. So as the yield for the 10-year goes up, the demand for dividend-oriented companies goes down. All right, that kind of worked out. And okay, that was good exercise. Let's look at the stocks going up and down the most. Um, we have SanDisk. That is up 8.2%. We have Seagate, Oracle, Datadog. Okay, we have a huge play on the AI data infrastructure. Okay, we had earnings reports from the Mag 7 this week, and they all projected a lot of spending on AI data infrastructure. Google, Amazon, Facebook, or Meta, they all said that they're going to almost double their spending in the AI world. So all the stocks involving that are going to go up with it. So SanDisk, they make um, hard drives and flash memory. You have Seagate, they make hard drives for data centers. Oracle, they they're making data centers themselves. Datadog, they're a major software provider for data centers, cloud infrastructure. Intel. Okay, so this and Micron, look at that. It's up another 5%. Okay, so top decliners. These are stocks that pay dividends. Clorox, boring companies that are steady, safe companies that pay dividends. So Clorox, Amgen, they're a drugs company. Brown and Brown, we have Bristol Myers Squibb, they sell drugs and pay a dividend. And Corning, that's interesting. Corning is a stock that makes glass fibers for AI data centers. You'd think that it would be up with the other stocks that are AI related. Right. And Amphenol, they also do connectors for AI data centers. So they should be up today. But that is a good understanding of what's going up and down. So we have an AI infrastructure day today. Okay. So let's look at Dan Now's picks. You can see that last week, Impinj, this PI, was down 30% for the year. And this week, it's only down 15%. So it must have gone up 15% in the last week. So we'll keep an eye on this. But we know that it doesn't match our criteria for stocks we're looking for. But it's interesting to see stocks that Dan Niles thinks is a high quality. And if they go down a lot, we'll have to start looking at it eventually. All right. So let's look at the narrative thanks to Google AI. Google AI says the current stock market narrative is defined by a robust AI-driven rally, with the S&P 500 hitting record highs, fueled by strong corporate earnings and a resilient consumer. Investors are largely overlooking elevated oil prices and geopolitical tensions in favor of expanding market breadth and potential for continued broad-based gains. Okay, that sums it up pretty good. So key aspects of the narrative are AI, boom, and earnings. That was reflected in our top stocks moving today in the stock market. Artificial intelligence boom with strong earnings reports from major corporations, including Apple, Google, and others, signaling continued growth. So the other thing is broadening leadership. The market is witnessing a rotation away from only big tech to old economy sectors and small caps beginning to participate in the gains. Resilient consumer spending trends continue to remain strong, with companies like American Express and Visa reporting continued customer stability. That's why when Visa reported this week, they said that the customer is spending and it's not going, and that's really good for the economy. Geopolitical disconnect. Despite rising oil prices caused by the Middle East volatility, the stock market remains relatively calm as measured by the VIX, suggesting investors are prioritizing corporate profits over geopolitical risks. So that is basically what we see in our top 10 stocks going up and down today. Okay. Okay, so it seems like right now we are in a risk on mode in the stock market. We have tech stocks, we have um, consumer discretionary, we have high PE stocks, high PEG ratio stocks going up. And that is um, the stock market looking past the current Iraq situation and to a time when we're out of the war. So let's look at a stock that we're following, Visa. You can see that Visa has been in a downtrend for a while, and you can see that it recently pu- it went up 10% this week. And we'll see if this is a breakout or not. I drew lines starting to go up. We don't know, but that was a very good earnings report. And you can see that we had a huge up volume day. And for me, I've owned Visa since it IPO'd, so I see it as growing at 15% in for next couple of years at least. So it's been a compounder for me, and it's one of my favorites because they have a good percentage of the market share of transactions in the world, and they don't have a whole lot of competition. They have MasterCard and Visa are like 80% of all transactions in the world for credit cards. Okay, let's look at another stock here that came up on our screen. This is Reddit. You can see that we have this base forming for like over a year, and we had a really good earnings report this past week for Reddit, and you can see that we're oversold, and we had over 10% up day this week. So I'm going to look at this stock a little bit more because they did have good earnings, and it is in our stock screen. Let's look at another one here. This is Google. You can see that Google went up like 10% this week or more. And you can see we're overbought. And we are also at the top of the range right now. So usually stocks go up in a zigzag pattern. You can see that it goes down, it goes up, and there's a good chance it could go back down again, especially whenever we're coming into the summer months. Um, so we'll see if it follows that pattern. But it's been my top holding for since 2007 or so, and um, this is an example of a stock that I buy and hold, and put in a coffee can and wake up um, and see it compound over time. Let's look at the news stories for Alphabet. Alphabet flexes its earnings muscle. The stock pops. Alphabet reported strong first quarter results on Wednesday. The stock went up nearly 10% on Thursday. Alphabet is rising. Um, Google reported 22% growth on the top line revenues and an 81% increase in profit. The company also upped its CapEx guidance in light of the strong revenue performance and outlook. So Google Cloud is their major um, sector that's growing the most. It's up 63%. Their revenue is up 63% for Google Cloud. So this is the first AI company that's spending a lot of money on the AI data infrastructure, and this is the first company that's actually showing a return on investment. And that is super important because the stock market is kind of scared of all the spending that's going on, especially with companies like Meta that isn't showing a one-to-one correlation to investment and return. So the company is also selling some of their chips. So they're a competitor to NVIDIA now. And that adds a new stream of revenue for Alphabet. And they raised capital expenditure plans. That means there's doubling the amount of money they spend. But you can see that they're growing. If they had the capacity, they would grow faster than 63%. So they're sharply raising their how much to spend, and that could hit their margins. So the other thing to keep in mind is they own a substantial portion of SpaceX and Anthropic. And whenever those companies go public, they're going to have a bump on their earnings for if those stocks end up going up a lot. And you know that sometimes whenever there's IPOs, stocks kind of go up, especially whenever there's a stock like SpaceX that is like they offer a product that no one else offers. So, all right. So this is story from Barron's. Big tech is spending on an unprecedented amount on AI. Only one company is making it work. So Google is taking the lead as the world's most valuable company for the first time. Um, and they're the only ones showing that actually their AI strategy is working and making profits. So that's good to keep in mind. A lot of times, whenever earnings come out, the CFRA company comes out with a note. And so their note was Alphabet posts strong Q1 beat, cloud backlog nearly doubles. So they reported Q1 results with revenue of 109 billion, 22 up 22% year over year versus 18% forecast, and EPS of $5.11. That's double of the consensus of 263. So Google Cloud was the best performer, and their cloud backlog nearly doubled. That means if they had the capacity, their earnings would be much better. So that's why they're spending a lot. And operating, yeah, so they're basically saying um, they have a potential with Waymo showing progress with 50,000, 500,000 autonomous rides weekly, and that's growing. So they have a lot of shots on the goal, and it's pretty exciting. I thought it'd be interesting to look at their earnings just one more time here. They're growing at 15%, average. And let me see, they're going at 16%. Their PE ratio is 32 now, and their PEG ratio is 2. So now they're 2 times overvalued. I like to say you pay more for a car that starts in the morning. Their profit margin is 3 times what we're looking for. Return on equity is 3 times what we're looking for. And they have more cash than debt. They have 30 billion in cash, and they make 27 billion per quarter in levered free cash flow, which is really good. So this continues to be my favorite stock um, of all time. And it's great to see that they're continuously innovating to grow in changing environments. Okay, let's look at what CFRA says again. They said they have a buy rating and they have a fair value. They say it's overvalued by 8%. So that's um, that's good to know. But you can see that their earnings are growing at a great clip over time. They're almost like it's 15% per year. And you can see, okay, Morningstar's fair value estimate is 433. That's they basically are saying that Google is 20% off. Um, they say they're increasing their fair value to 433. So that's up from where it's at right now. So that is another good check mark vote of confidence. Let's look at our stock screen for this week. Um, we're not going to go into Micron or GE Vernova because we went through those extensively before. But one stock came up on a screen. It's called Reddit, and you can see that um, it has green and yellow across the board. That means it says it's 13% undervalued in the PEG ratio, and its forward long-term growth is 54, which is really good. And okay, so it has some potential. So it's a smaller stock. So we're going to look at it to see if it has any credence. I don't know if you know Reddit. It's a place where you go to chat with other people and post blogs and allow people to comment on your posts. Okay, so um, the CEO of the company basically said they're making a niche in the world of AI. People need to talk to each other. So that's how they're differentiating themselves from other companies. Let's look at their chart of Reddit. You can see it's a sideways kind of pattern for over a year. And we had a really good volume day where it went up 13% in one day. And that could be a breakout of this year sideways pattern. And you can see we were overbought at this time, oversold, I mean. So let's look at some of the financials of Reddit. You can see that they're growing about 42% from this year to next year. The forward PE ratio is 40. So the PEG ratio is 1. So it's about fairly valued. You can see the profit margin is double what we're looking for, and return on equity is double what we're looking for. And they have 2.5 billion in cash, which is really good. And so this is a smaller company. It's a $32 billion company. So their operating cash flow is they have positive cash flow that's half a billion in free cash flow, which is good. Okay, so it checks off a lot of our um, statistics. Let's look at an article on RDT Reddit, and it says advertiser demand and product expansion drive record growth. Okay, so this is online community and discussion platform Reddit reported Q1 2026 results beating Wall Street expectations. This is this past Friday, with sales up 69% year on year. Guidance for next quarter was better than expected at 720 million at the midpoint, 1.3 above estimates. Okay, so their profit was 26% above analyst estimates. So it looks like it's fairly valued, but if we look at the chart, you can see that it has the pattern that we really like. Whenever you have the exponential moving average, which is the yellow line, you can see that when it starts turning up and whenever the stock starts going above that exponential moving average and starts going up, then that's a good sign it's going to break out of this pattern and start going up. And whenever these moving averages start moving up, that's going to help the stock get momentum. And we'll see. This is a smaller stock. It's not something that I normally would invest in. I like stocks that are large cap, like Google and um, Apple and Microsoft. But this company is smaller, so it's not as reliable as Google for their earnings. Google would go up 15% a year, you know, but regularly, and they have multiple ways to meet those estimates. But when you have a smaller company, it's not as reliable, and you could get caught in some where they don't meet a certain quarter's estimates, etc. So, but it looks like it's a good time to invest in it on the chart, and it's a fairly valued, so it doesn't really have a margin of safety. So that's the tricky part. It's a P ratio of 40 with a 40% growth rate. So I like to buy it at a discount whenever it has a PEG ratio of less than one. But it seems like a decent stock that's going to grow because it's a smaller stock. And um, I don't know. That was an interesting excursion. All right. There's another story. Um, Bill Ackman recently started his own ETF. And when he was talking about his ETF at the New York Stock Exchange, he mentioned the ETF is going to be holding a lot of the stocks in his Pershing Square management holdings. So I thought it'd be interesting to look at the changes in his top 10 holdings. He likes to have concentrated holdings of stocks. You can see that he, in his most recent quarter, sold out of a majority of Alphabet. This was his biggest holding not too long ago. Um, no, well, actually, let me see. He sold out of a portion of it, but he actually bought a company called Brookfield Corp. And it's interesting that he would invest in this company um, right whenever we're having a crisis with these kind of companies. Brookfield is like an investment company. They do private credit and investing in non-public companies around the world. So I thought it'd be interesting to go into, this stock that he has most of his portfolio with, 18%, and he still has 12% in Google, which is pretty big, but he sold off a portion of it. Let's look at what other stocks he's holding. He's holding Uber and Amazon. Amazon went up a lot recently. Um, and he bought Meta, QSR. And his theme for investing, he loves residual income. So companies like Hilton is actually a company that licenses their name to companies. So if I own a hotel and I have the option of actually using the Hilton name, paying the Hilton company royalties to use their name. So Hilton gets a portion of every sale of their companies that use their name around the world. So QSR is very similar. And he also invests in BC. Okay. All right. That's all I have to say about that. All right. So we're going to look into Brookfield, which is his top holding in his Pershing Square Capital Management. Okay. So first of all, what does Brookfield do? They specialize in alternative investments, including things like real estate infrastructure and private equity. This private equity word is is like the equity companies now have gone down 50 or 75% from the beginning of the year. So this is a very touchy, very touchy subject and stock to invest in. It's very risky because the whole sector is going down. And if you buy 18% of your company, of your assets into this company, it might have very similar private equity issues. So they have over 2,000 investments in 30 countries worldwide, and they offer its portfolio to both institutional and individual investors. So one thing that I'm thinking is, what happens if you have a run on this company? What if all of these individual investors and institutional investors want to get out, and then they have to sell some of these investments to cover that, and then they might sell it before they realize the true worth of the investment. So that could be one problem with this company. The company, let me see, includes both sovereign wealth funds and pension funds. Why does he like it? Why does Bill Ackman like it? He thinks he likes companies that are the backbone of the global economy. So he considers this a company that's part of the backbone of the global economy. They have data centers, energy infrastructure, which is part of the AI boom right now, logistics, infrastructure investments. So it nicely fits within a preference for small, predictable business that fare well under almost any economic conditions. So, so it's not easy to understand. They have 2,000 different investments over 30 countries. It's very similar to Berkshire Hathaway. If you have a lot of things going on, it's really hard to understand what you're getting into. So he must have done research on this company to really know what it's worth and what it's invested in. So according to this article, this Google AI, it's with more than 1 trillion in assets and a debt-free balance sheet. The company also enjoys a combination of scale and limited financial risk. Okay, they said it's debt-free balance sheet. I looked at their balance sheet; it wasn't debt-free. Um, so Ackman thinks that BN trades at a significant discount to intrinsic value. This discount is evident when one compares its net asset values at the end of 2024 to its present market cap. So let's look at the financials of this Brookfield to see if it makes any sense. They're actually, look at this. Their growth from 2025, it's 15, then it's 22, then it doubles to 48% growth in 27 to 28. So that's pretty amazing, the earnings growth. So they're growing right now. Let's say we take the difference between 22 and 48. That's like 35%. The PE ratio is 12, which is really low. The PEG ratio is 0.25 or 3 times undervalued. So it's based on the earnings growth and the PEG ratio, it seems like it's a good deal. But when we look at the profit margin, it's only 1. That is really bad. And return on equity is only 2, which is 6 times lower than we're looking for. Um, the cash is 16 billion and the debt is 272 billion. So when they said that the company doesn't have debt. I don't know what they were talking about. They have 272 billion in debt out of a market cap of 100 billion. That's a really big red flag if that's right. That's from Yahoo Finance. They have almost triple, they borrowed almost triple their market cap for investing. And they're negative in their levered free cash flow, which is kind of another red flag. So I don't know. I don't know what Bill is thinking. On top of all this, you have to worry about private equity as a part of their business. There's too many, it's not easy to understand for me, so I'm going to stay away from this one. You can see that it's in a sideways pattern for the past year or so. So I don't see a margin of safety. I do like this where it's 1/3 times undervalued based on their growth rate and their PE ratio, but it's just too complicated for me. So I'm going to stay away from this one. Um, okay, that's all I had to say for today. Hope you enjoyed the talk, and um, I'll see you next time.